Welcome to Talk Tickers. We are diving deep into the SkyWest Inc. That's SKYW Q3 2025 earnings call. It dropped just after the bell on October 30th.
That's right.
And for anyone following the stock, you'll know the story here isn't just the numbers, it's really the reaction.
Oh, absolutely. The initial price action was, choppy, a little bit of maybe confusion on the guidance, perhaps.
Yeah, seemed that way.
But the next day, that market reversal was just, definitive. Overwhelmingly positive.
And that kind of signal, that tells you the market really bought into the long-term strategic story management laid out.
Exactly. The core message was super clear. Strong execution, combined with really brilliant long-term asset management. They're playing the long game.
So our mission today is to unpack that plan. We see a company like strategically using older assets, predictable revenue to fund this huge shift to a modern high-margin fleet. We're feeling, constructively bullish on this story, and we want to show you exactly why. Let's start with the headline beats, the numbers that grabbed everyone right away.
Okay, yeah. The financials were exceptionally clean. So GAAP EPS, $2.81.
$2.81. And the consensus was what, $2.56?
$2.56, yeah. So that's a really robust, 9.8% beat, almost 10%.
Wow. That kind of margin, it really points to tight cost control, great operational leverage.
And the top line matched it. Revenue came in at $1.05 billion.
Which beat the streets, roughly $1.015 billion number.
Yep. About a 3.5% beat there, and significantly a 15% jump year over year.
15%, that's healthy growth.
And that strength just flowed right down to the bottom line. Operating income saw a big jump, 33% year over year, hitting $174 million.
Okay.
But, the hidden strength, I think, is in the operational stats. Management really hammered this point home.
The completion factor stuff.
Yeah, continued excellence, over 185 days of 100% controllable completion year to date.
That's amazing. Think about that.
Yeah, almost 2/3 of the year with perfect operational control. And that's despite, as they noted, the whole air traffic control system being pretty strained.
Well, that operational excellence, it's basically the bedrock for their entire model, isn't it?
Absolutely.
And for anyone needing a quick refresher, the foundation for SkyWest is that capacity purchase agreement, the CPA model.
Correct. The CPA model really is the golden ticket here. It means SkyWest gets paid for every hour the plane flies, each block hour. Doesn't matter how many seats are full. It doesn't matter what the ticket price was.
Right. So all that volatility around demand, fuel prices, ticket prices.
It almost entirely shifts onto their major airline partners, United, Delta, American, Alaska.
Leaving SkyWest with this highly predictable, fee-based revenue stream.
That's the magic.
Okay, now let's dig into the capital structure, because this is where you really see management setting up for that long game. Deleveraging is still a huge focus.
Definitely. Total debt is now down to $2.4 billion.
Okay, and that's down from what, $2.7 billion at the end of last year, 2024?
Exactly. So a $300 million reduction. They're clearly prioritizing paying down that debt.
And the cash flow is fueling that.
Oh, yeah. They generated nearly $400 million in free cash flow just through the first 3 quarters of 2025.
Wow.
This cash generation is basically the engine funding that future fleet transition we talked about.
Okay, but here's maybe a little point of friction.
Right.
If deleveraging is a priority number 1, what about the share buybacks? Are they really prudent right now?
Oh, the buybacks, yeah.
They bought back 244,000 shares, cost them $26.6 million. Average price was like $108.83 in Q3.
Right.
And they still have $240 million left on the authorization.
Yeah.
So is that signaling confidence, or maybe missing a chance to pay down debt even faster?
Well, look, I think it's a calculated balance, and I actually read it as a strong signal of confidence for management.
Right.
Because they're generating so much free cash flow, they can basically walk and chew gum at the same time.
Right.
They can aggressively cut the debt and step in opportunistically to buy back stock when they feel it's undervalued, which they clearly did in Q3. It shows, financial maturity and discipline, I think.
Fair point. Okay, the other key financial detail we need to touch on is that deferred revenue mechanism.
Ah, yes. Important piece.
They recognized $17 million of previously deferred revenue in Q3. That's a little down from Q2's $23 million.
Right. It fluctuates a bit quarter to quarter.
But the really crucial figure is the $269 million of cumulative deferred revenue still sitting there on the balance sheet.
That number, that $269 million, is absolutely central to their predictability. Think of it like a guaranteed earnings floor.
Okay.
It's completely shielded from operational hiccups or, external demand shocks. This buffer just smooths out their future earnings profile and reinforces the safety of those CPA cash flows way into the future.
So if Q3 was all about nailing the execution, the real driver for that big stock reversal was probably the forward look, the guidance.
I think so, yeah.
Let's unpack what that guidance tells us about their momentum going into 2026.
Okay, the implied numbers look really, really constructive. Management basically guided that 2025 GAAP EPS is now expected to land in the mid-$10 range.
Mid-$10 for the full year.
Right.
Okay, so doing the math, that implies Q4 earnings need to be around, what, $2.30 per share?
Yeah, somewhere right around there. A very solid Q4 forecast baked in.
And the growth isn't stopping at year-end. Their 2026 projection.
They expect EPS to grow by mid to high single digits next year. If you run the numbers, that translates to roughly $11 per share for 2026.
$11. Okay. What about operations? Block hours.
So block hours are expected to be up a strong 15% year over year in 2025 overall. But that growth really moderates in 2026. They're guiding to low single-digit growth next year.
Low single digits. Why the slowdown?
Well, that moderation is important. It reflects a shift, really. They're moving from just sheer volume growth to more stable utilization as they manage all these fleet transitions.
Makes sense. They're swapping out planes.
Exactly. And this transition, it requires serious capital investment. CapEx is high.
Right.
We're talking $550 million total for 2025. And then for 2026, they're projecting $575 million to $625 million.
So still spending heavily.
Yeah, they're investing heavily in that new E175 fleet and also making sure the current fleet stays competitive and reliable through refurbishment.
Okay, this brings us perfectly to the strategic fleet decisions. Because this is where I think the real genius of their asset management shines.
Agreed.
The announcement that kind of stunned analysts, I think, was the CRJ200 Lifeline.
Oh, yeah. That was a masterstroke of asset monetization, really.
Explain that.
They secured a multi-year extension with United for up to 40 of their oldest planes, the CRJ200s. These things were expected to be retired soon. Now their operating lifespan is pushed well into the 2030s.
So for you listening, picture this. It's like having a 20-year-old rental property, fully paid off, fully depreciated.
Right.
And suddenly a top-tier AAA-rated tenant signs a new 10-year lease on it.
That's a great analogy. And crucially, they confirm these are all contract aircraft under the CPA model.
Not pro-rate risk.
No, they aren't relying on the volatile pro-rate market for these specific planes. It's guaranteed high utilization block hours for assets that, frankly, most people thought were heading to the desert.
So it preserves utilization, preserves cash flow from an aging fleet.
And provides this massive, predictable bridge funding their transition to the next generation E175s. It's brilliant timing.
Okay, speaking of those E175s, that big fleet transition isn't completely smooth sailing, right? They mentioned some issues.
Yeah, some friction in the supply chain, specifically with the manufacturer, Embraer. It's pushing some deliveries that were originally expected late this year, 2025, into 2026.
So how many are we expecting now?
We now expect just 3 deliveries in Q4 of 2025, with another 11 coming during 2026.
Delays are kind of the name of the game in aerospace right now, though.
They really are. But what's super interesting here is how they've structured their total order book for the E175s. They have 74 firm orders stretching out through 2032.
74 firm.
Okay, but here's the kicker. Only 30 of those are currently allocated to specific major partners. That leaves 44 completely unallocated slots.
44 planes without a home yet. That sounds flexible.
It's more than flexible. It's the ultimate negotiating chip.
How so?
Management explicitly said this gives them crucial flexibility, the ability to defer deliveries, assign them to partners as needed, or even cancel those frames entirely if they don't secure partner demand for them on acceptable terms.
So they're not stuck taking planes they don't have contracts for.
Exactly. This optionality, this control over future E175 delivery slots through 2032. Honestly, it might be the single most valuable, maybe hidden asset on their balance sheet.
Because the major partners desperately need those new regional jets and those delivery slots.
Precisely. It allows SkyWest to really dictate terms in future negotiations.
So if you net it all out for their main capacity purchase business in 2026, what does the actual capacity change look like?
It's pretty much flat, maybe slightly positive growth, but the real story is the upgauging.
Meaning bigger planes.
Yeah. They're bringing on 20 additional CRJ 550s. Those are the premium 50-seaters and the 11 new E175s next year. But that growth gets largely offset because they're returning about 24 Delta-owned CRJ 900s over the next couple of years.
Okay, so it's a very managed, very controlled transition, moving away from older planes into these newer, high-margin, dual-class jets.
Exactly. Stable transition, period.
Now, beyond that core CPA flying, they've got two other growth areas that look pretty impressive. First, SkyWest Charter, or SWC. The DOT finally approved that commuter authorization.
Yes, finally, after a 3-year review process.
What does that actually let them do?
It basically opens the door for flexible, non-scheduled flying opportunities. Think charters for sports teams, corporate shuttles, maybe quick fill-in flights for small communities outside the strict routes of their major partners.
So a totally new revenue stream using their existing planes and pilots.
Incremental revenue, yeah. And second, their traditional pro-rate business, flying under their own certificate, that expansion is still going strong.
Pro-rate demand is solid.
Very solid. Currently running at about 70% of 2019 levels.
Okay.
And what's really key here is how that pro-rate business is shifting. It used to be mostly small, single-class CRJ 200s.
Right.
Now it's moving toward higher-margin dual-class planes. CRJ 900s flying for American, CRJ 550s flying for Delta.
Which lets them fly into bigger, potentially more profitable markets on their own dime.
Exactly. That American pro-rate deal alone is expected to grow to potentially 9 aircraft by the middle of 2026. It's significant incremental growth.
Okay, finally, we should touch on the external challenges management talked about. The CEO commented on the federal government shutdown risk.
Yeah, specifically around the Essential Air Service Program, EAS.
Right, funding for those vital small community routes.
They anticipate the current funding only runs through November 18th.
And what did management say they do if the funding gets delayed by political gridlock?
They made a very public commitment, actually. Said they would continue flying for these EAS communities even if the funding lapses temporarily. They see it as an economic lifeline.
Wow. That's a big statement. How would they manage that financially?
They acknowledge that continuing service without reimbursement would mean having active conversations with those communities, trying to manage the financial strain together. It shows real commitment to those routes.
And the other external piece, the Brazilian tariff on imported aircraft.
Right, the long-standing 10% tariff on certain planes, like the Embraer E175s. Management basically said, we're dealing with it.
Just part of doing business now.
Pretty much. They called it an obstacle, especially for serving small communities affordably, but emphasized they're executing despite it. They've navigated periods when that tariff was much higher, so it seems like a known cost they've already factored in.
Okay. That covers the call pretty thoroughly. Now, it's time for our not financial advice segment.
The fun part.
Indeed. But before we pitch our idea, let's be absolutely crystal clear. This is purely for entertainment, for discussion. It is not a recommendation to buy or sell anything.
Definitely not. We are just brainstorming right alongside you, kicking some ideas around based on what we just heard.
Think of it as us making a rational, maybe slightly aggressive pitch to an imaginary investment committee in our heads.
Okay, I'm ready. What's the pitch?
All right. My pitch tries to leverage SkyWest's unique position, right? That shielded revenue model compared to all the noise and risk hitting the broader airline industry.
Makes sense.
So the idea is a paired trade. You short the U.S. Global Jets ETF, ticker GGS.
Okay, shorting the whole sector.
While simultaneously taking a robust long position in SkyWest, SKYW.
Interesting. Short JEETS, long SKYW. But why short the broader sector right now? We just heard from American Southwest. Demand seems pretty resilient, right? Doesn't that kind of argue against shorting jets?
It does, but only if you look purely at the consumer demand side, I think. While the desire to fly is strong, the airlines in JEETS, the actual operators, they still face huge unhedged risks hitting their bottom line directly. Think escalating labor costs, wildly volatile fuel prices, general macro uncertainty that can hammer passenger revenue per mile.
Right, all that operational volatility.
GTs captures all that volatility. But SkyWest, under their CPA model,
is essentially immune to those exact same risks. Fuel, ticket pricing, demand fluctuations.
Precisely. SKYW is uniquely shielded. They get paid that block hour fee pretty much no matter what. So we're capitalizing on the inherent volatility of the legacy carriers via the JT's short.
While betting on the predictable contracted earnings power of their biggest capacity partner, SkyWest, on the long side.
Exactly. And that multi-year United deal for the old CRJ 200s. That provides an extraordinarily high floor for SkyWest's utilization and cash flow way out into the next decade.
Yeah, that differentiates its earnings power massively from the volatile sector average you get in JTs.
It's a classic setup, really. A relatively low-risk, high-contract security play against pure operational risk and macro exposure. That's the thesis.
Okay, I see the logic. It's definitely playing on SkyWest's unique insulation.
So wrapping things up then, Q3 was definitely a clean beat financially.
Yep, supported by really visible progress on cleaning up the balance sheet, paying down debt.
And those strategic contract wins, especially that CRJ200 extension with United.
It just completely validates management's long game approach. It gives them the breathing room, the financial bridge they need.
Yeah, it truly sets the stage for that stable, well-funded transition away from the older planes.
And into that new high-value E-175 fleet over the coming years.
Which brings us then to our final provocative thought for you to chew on.
All right, leave them thinking.
Given those 74 firm E-175 orders stretching out to 2032, and remember, 44 of those are still unallocated.
Right, the flexible ones.
How much real leverage does that delivery slot optionality give SkyWest in future contract talks with their major partners like United, Delta, American, who desperately need that new regional capacity? Is that ability to control the supply of new regional jets for the next decade maybe the single most valuable, if unquantified, asset on their balance sheet? Does it make them less like a simple airline operator?
And more like a strategic fleet landlord dictating terms.
Exactly. Something worth considering as they navigate the next decade of regional flying.
A great question to end on.
Well, thank you for joining us for this deep dive into the SkyWest Inc. Q3 2025 earnings call.
Yeah, thanks for tuning in.
We'll catch you on the next one.